The decision by the Reserve Bank to keep the repo rate unchanged means debt repayments by indebted consumers will remain the same. The Reserve Bank, however, says risks to the inflation outlook are still assessed to the upside. It's concerned about domestic food price inflation, which it says remains volatile, and the expected dry weather conditions also present longer-term concerns. The volatile rent, electricity prices, and logistics constraints also present significant risks. The central bank has slightly revised downward inflation expectations for this year to 5.8% from 5.9% earlier. It expects inflation to average 5% next year and to reach the midpoint of the target bracket in 2025.
The MPC decided to keep the repurchase rate at the current level of 8.25% per year. The decision was unanimous. At the current repurchase rate level, policy is restrictive, consistent with the inflation outlook and elevated inflation expectations. Serious upside risks to the inflation outlook remain.
Economists believe the interest rate hikes have been impactful in curbing inflation. The Reserve Bank has raised interest rates by approximately 475 cumulative basis points since the end of 2021. This has put indebted consumers under pressure as they had to pay more on their debt.
From the consumer's perspective, it will be really about cutting back where you can. That is really what the hike in interest rates are intending to do. It's intending to slow things down. And it's painful, but it is the one method we know that ultimately works. It slows demand, and therefore it brings pricing discipline back, both on the side of companies and on the side of organized labor. So the best advice for consumers would be as disciplined as you want, as you need to be. Don't overextend yourself, and if you are in trouble, speak to your bank.
Interest rate cuts are expected only in the second half of next year if inflation trajectory pan out as expected and risks do not materialize.
We can't say categorically that the Fed rate cycle has peaked yet. I think that will have an influence, especially through global financial conditions and what happens to the rand. The second thing that is important is inflation expectations. The governor mentioned this again today. They are a little bit higher than where the bank would like them. Bank wants them more in line with the midpoint of the inflation target range, closer to 4.5. So I think that the Reserve Bank will probably wait for those two factors to pan out, which does push us later into next year.
The Reserve Bank now expects the local economy to grow at 0.8% this year, slightly higher than the 0.7% earlier forecast. It raises energy and logistics challenges as serious constraints and says a sustained reduction in load shedding or greater energy supply from alternative sources would significantly increase growth. Gloria Sefako Musi, SABC News, Johannesburg.